Hello everyone. In today's video, I am going to talk about Joe Biden's administration's new proposed 401k changes. You might have heard from your friends or colleagues that the new Biden administration is proposing changes to your 401k retirement plan. The 401k is a retirement tool used by millions of people living in United States. Although it is used primarily as a retirement tool, there is also tax benefit to contributing to a 401k retirement plan. Hence, any changes made to a 401k plan will affect the taxes you owe to the government each year. To learn about 401k plan in details and whether you qualify and should be contributing to a 401k plan, please look into my previous video in this channel. The link is provided above and also in the video description below. Before we go into details about the proposed changes, first, let's look at basically how is the taxes calculated for your income in the United States. We have a tiered tax structure to calculate the taxes owed for any income earned during a given year. What that means is that you do not pay a single tax rate for all your income, but rather you pay different tax rate for different range of your income, which is shown in the table below. We sometimes refer to this as the marginal tax rate. For example, for someone earning up to $9,875, marginal tax rate for them will be 10%. But if your income is above $9,875, you pay a higher marginal tax rate. For example, if you earned $50,000 in any given year, your highest tax margin rate is 22%. But remember, up to $9,875 you only pay tax at 10%, and for income up to $40,125 you only pay. Hence, even though your marginal tax rate is 22%, your effective tax rate is much less than 22%. While filing your taxes, you can make number of deduction to reduce your taxable income and hence reducing your maximum marginal tax rate. One of those deduction you can make to reduce your taxable income is any contribution you made to your traditional 401k plan. Additionally, you also qualify to receive a tax credit which you can use to subtract the dollar amount from the taxes owed to the IRS. In conclusion, deduction reduces your taxes by reducing your taxable income, whereas credits reduces the total tax owed itself. Next, let's look at tax benefit of contributing to a traditional 401k plan. As I have stated previously, any contribution made to a traditional 401k plan is treated as a tax deduction, which in turn reduces your taxable income. For year 2020, you can defer paying taxes for income up to 19,500 and an additional 6,500 if you are age 50 years or older. So, as the traditional 401k contribution is treated as a tax deduction, the tax benefit you get by contributing to a traditional 401k plan depends on the marginal tax rate you are currently paying. For example, if you are in the 10% tax bracket range, then for each $100 you contribute to a traditional 401k plan saves you $10. Whereas someone who is in 37 tax bracket range save $37 for each $100 they contribute to a traditional 401k plan. So if you look at it in one way, low income earner who are in lower tax bracket will get less benefit, whereas higher income earner who are in higher tax bracket will get more benefit in the current system. Next, let's look at the proposed changes to the 401k contribution and how the Biden administration is saying that they are trying to equalize the benefit to lower income people. First, they are proposing to remove the 401k tax deduction completely. Instead, they are proposing to give you tax credit for your 401k contribution. The proposed 26% tax credit is roughly equivalent to a 20% tax deduction if you convert it to a deduction. Additionally, this tax credit is fully refundable. That is, if you owe less taxes than the tax credit you qualify for, then you will be refunded the difference by the IRS when you file your taxes. Another proposed change is creation of automatic 401k for workers who do not have access to workplace retirement account. Also, caregivers who are working at home can make additional catch-up contribution to their 401k plans. Now next, let's look at how does these changes affect you and your tax strategy. So as you can see in the table below, for people who are in the lower tax bracket, they will get more benefit than the current tax system. Hence, people in the 10 and 12% marginal tax bracket should contribute to a traditional 401k plan if they want to maximize their tax benefit. But for anyone who is in a higher tax bracket, that is, anyone in marginal tax rate of 22% or higher, may choose to contribute to the Roth 401k plan as their benefit has been reduced. And they will still get the $20 tax benefit by contributing to a Roth 401k plan. And last but not the least, I would like to remind everyone that all these proposed changes are still under consideration and have not been made into law. Hence, these proposed changes might change when they are finally made into a law by the Congress. Thank you guys for watching my video, and if you like my content, then please don't forget to like this video and subscribe to my channel.